how is AI disrupting the asset management industry?
I think the way AI, I wouldn't actually call it a disruptor, but much more an enabler, at least for now. It's making things a little bit easier in terms of analyzing companies, reports, and things like that.
There is this misconception from individual investors that bonds are just for retired people. Why do you think that misconception exists, and what do younger investors need to know about fixed income, which essentially are the bond funds?
Like in the news media, equity gets probably the lion's share of the sort of coverage. Bonds are, they're much more complex.
Hello and welcome to the Investing and Other Stories podcast. I'm your host, Margarita, a former Wall Street executive, CFA charter holder, and founder of Finance Latte, a leading investing education company. I founded this podcast to fill what I was missing in the finance industry, a place where top women investors can share insights directly with individual investors to empower them and inspire them to invest more and build wealth. It doesn't matter if you've been investing in stocks, funds, or startups for years, or you're just getting started. This podcast is for you. All right, so I am so excited about today's episode because we are welcoming Tina Adatia, Managing Director at Goldman Sachs. We will discuss everything that has to do with bonds, the trends in bonds, and the sub-asset classes within it. If you think bonds are boring, this episode is for you. The views and opinions that Tina will express today are her own and are for informational purposes only and do not constitute a recommendation by Goldman Sachs Asset Management for you to take any action. Stay tuned at the end of this episode for more important disclosures. Tina Adatia is the Managing Director in Fixed Income and Liquidity Solutions within Goldman Sachs Asset Management, serving as Head of Client Portfolio Management. In this role, she oversees Goldman Sachs multi and single sector client portfolio management team globally, partnering with the firm's client business to engage with fixed income clients and prospects around the world. Tina joined Goldman Sachs in 2024 as a managing director. Prior to joining the firm, Tina worked at PIMCO for 19 years, where she led their core global fixed income and short-term product strategy business, as well as their sustainable product strategy group. Earlier in her career, she was on the consultant relationship team at Henderson Global Investors, and before that, Tina was an investment associate at Hewitt in London. Tina earned her bachelor's degree in economics and actuarial science from the University of Southampton and is a CFA charter holder. Tina, what an incredible career. I'm so glad you're here and a warm welcome to our podcast.
Thank you. I'm so excited to be here. Thank you for letting me join and talk about bonds and fixed income and anything else. I'm super excited to do this today.
Wonderful. Let's get started. So you've been in asset management for 2 decades. What first drew you to finance, and what's kept you passionate after all these years? I really want to know.
I think that's an interesting question, and I get asked that a lot at various points from candidates and when you're on panels and things like that. And it's a bit of a surprising one. When I was obviously young, I was a pretty studious kid, so I was good at everything. And coming from an Indian background, forced to be good at maths and you're forced to be good at science, one of the smartest kids in the school, so what should I do? I'll be a doctor. So I did maths and sciences at A-level here in the UK. And then the sciences didn't quite work out for me. And so when I was picking my uni courses, somebody suggested, oh, this economics course sounds interesting. I quite liked the actuarial, the statistics part of it. I just ended up being better at maths than I was at sciences. And from there, economics and actuarial science, which sounds like a completely boring degree. I think most of your listeners will have heard of economics, but maybe not the actuarial science part. It was really that what drew me to that was the modeling and the statistics. We got to do a lot of demographic trend things that fitted quite well. It allowed you to have a much more full understanding where finance is implemented. So pension funds, insurance companies, and things like that. And so I'd already learned about interest rates because we were doing discount pricing and things like that. But again, I didn't really even know when I left university that I was going to be in asset management. So I fell into investment consulting at Bacon and Woodrow because naturally most people that do some sort of actuarial science degree go on to some sort of consulting firm, normally in pensions or insurance. But I didn't really like that. I did an internship in their sort of pensions area and I saw the investment side, I was like, oh, that sounds interesting. So I asked for the full-time job in the investment team. When I realized I used to talk to all the asset managers. I thought, actually, I'd quite like to be on the asset management side of things. So I got a job at Henderson, and that was a little short-lived. It wasn't any plan or anything like that, but something came up at PIMCO. At that point, I didn't even know fixed income. I always thought equities were much more important, but I just loved the people I talked to, and it seemed like a place where there were lots of junior people that could train you, so on and so forth. And so I fell into fixed income and bonds just because of the people around me. I didn't know that I would end up at one of the leading fixed income houses because I hadn't even heard of PIMCO at that time, to be fair. But then once you're there, you're just living and breathing fixed income, you're doing the CFA, and it really becomes part of it. And what I loved about finance, and particularly fixed income or bonds, was the economic part really matters. So when you hear the news and when you hear what's going on in terms of mortgage rates and so on and so forth, those things really matter much more than they do in other areas. So that economic part isn't necessarily just an obscure sort of distraction. It really just becomes kind of part of your job. And that's why I loved it and I fell into it.
I love it. I love how you tie the economics part, and a lot of stock investors hear that and like, yeah, that's not for me. That's not information I use, but you do use it, which must be also very interesting.
That's right. Yeah.
So we said in your bio that you're a client portfolio manager, but many of our listeners might not know what that actually means. Can you break it down for us in simple terms?
Yeah, that's a really great question. In asset management and in finance, we like to come up with all these names and titles, and every firm is different. When I think about what I do day to day and what my team does day to day, what we actually do is we are the experts from an investing standpoint for clients. So we will speak to clients about their portfolios, about what worked, what didn't work. We will also pitch new products. We will design new products. We're not managing the portfolios day in, day out in terms of deciding exactly what bonds to buy. But what we're doing is we're working with clients to understand what they want, to develop those solutions, and then over time discussing with them what worked in their portfolio, what didn't work in their portfolio. Do they need to change something in their portfolio? So you can think of us as the sort of client experts within the investing team. A different way to put it, if I was looking at what are the sort of key measures of success for my team, are driving kind of commercial outcomes. And commercial outcomes can be growing the business overall, but it also is about client experience and making sure that clients are happy with what they get. Defense, of course, the most important thing, and making sure that every time you interact with the client, they get what they need. So my group really are there to drive that commercial footprint of the business, and they will do that by ensuring that they grow their client base, ensuring that the clients that they have are happy and understand what's going on, if necessary move them, and also designing new strategies. So if, for example, there is something interesting in terms of trends in the bond market, we will have individuals thinking about if there's a product that we can do to respond to that. We've been looking at, for example, in the sustainability space, if we can create a portfolio that finances that sustainable transition in emerging markets. It's not an area that is covered very heavily by lots of asset managers, and it's an area that it's very targeted because it allows you to direct financing exactly to the right place. So that's an example of that. There are many examples of that. And then I think complete that picture, when you're driving those commercial outcomes, you then need to also produce content, be that content about the strategy or content about the market, or why should I be investing in this area? And so they've worked very closely with our marketing colleagues and our sales colleagues to ensure that we are producing the right type of information so that investors and those people that are not investors today are informed about what we do and how we do it and what we think.
Absolutely. I love the many facets that you explored around it. And if I may attempt to add to it and really simplify it, so there are bond fixed income products like the bond funds on brokerage accounts or institutional products as well. The investment team that runs them and makes the investment decisions. And then you are the bridge towards the client, right? You take that investment expert and communicate that. And your clients are, who are they? They're not individuals, right?
Yeah, I should have answered that. And I think you described my job much better than I did. So thank you for that. So all sorts of different types of clients. Most wealth at the moment owned by large institutions. For example, if you are contributing to pension funds on a regular basis, they will invest. Insurance companies, when you have, of course, your insurance, you pay your insurance premium. A company then puts that balance sheet to work effectively, and then they buy investments such as fixed income with them. So they can be considered institutional investors. On the other side, we also have those that you would describe as more wealth or retail. So that's like me and you. And the way that we would invest, of course, is we would go through our financial advisor or our bank, or we would go and buy an ETF on some sort of platform effectively, where you would basically buy those strategies. So you do have funds that are designed for end investors. We don't talk to the end investors directly. They usually come through either a platform or a distributor, but that would be the other area that we have solutions.
Wonderful. And there is this misconception from individual investors, especially the younger ones, that bonds are just for retired people. I do keep hearing people, individual investors, especially beginner ones, are like, oh, I'm just going to buy a stock ETF, invest in the S&P 500 or something along those lines. So there is that misconception, again, that bonds are just not for them. Why do you think that misconception exists? And what do younger investors need to know about fixed income, and which essentially are the bond funds?
Yeah, I think that's a really good question. And there are just so many different ways to answer this question. You're absolutely right. Like in the news media, obviously equity gets probably the lion's share of the sort of coverage. So that kind of has an impact on people's investment decisions. But if you think about what bonds are, they're much more complex, and maybe that's the reason why people stay away from them. So what a bond actually is it's an instrument where you lend to either a government or a corporate effectively, and then you will give them that £100 and then they will give you interest on a quarterly or a semi-annually basis. Then after a certain period of time, say 5 years or 10 years, you will then have the maturity come back. So you will get what you paid for the bond plus maturity at the end, and then coupons in between. So you get kind of interest. So it's effectively you're lending to that government institution or that corporate effectively. It's more like a loan, whereas opposed to an equity where you're just investing in that corporate, and there's not really an obligation to pay back. If you want to get your money back, you have to put it in the market and someone else has to buy that off you effectively. So it's a little bit of a different type of instrument. So that makes them a little bit usually less volatile, or some people might say safer, but it really depends on who you're lending to. And you can decide how much you're willing to charge, so how much interest that should be paid for that particular loan that you're providing. And fixed income is effectively that. And then if you look across the bond market, one thing that's quite different in the bond market to the equity market is that you do have different types of institutions where you can invest in. So you can invest in the UK government or US treasuries, and so they will then use that to pay a budget or whatever, and you will be financing that. But that's considered reasonably safe because you know that you're probably going to get your money back. And then as you go further up, you can lend to a corporate, similar to how you would when you're investing in an equity. But then there are different types of corporates, some which are considered lower risk and some which are considered less creditworthy or sort of high yield institutions. And you can get a higher return for those over time. So the point is, like, the fixed income market has things that are less risky or lower risk, all the way up to things that are closer to equity in terms of risk. So they do provide both the return component, which is similar to equities, but they can also be hedge against risky assets. So if you think about what's been happening year to date, particularly in the US equity market, where you've seen a sell-off in the US equity market, what's happened to US government bonds is actually they've outperformed. So they've produced a positive return. So what you tend to find is that the fixed income tends to be much more of a stable source of return over time, whereas the equity is much more of a growth thing. So over time, coming back to if you're a young person, how you should invest, usually you are going to have more of the riskier, whether that return-seeking investments. So whether that's the equities or the higher risk bonds, for example, those return seeking, because you can afford to take a bit more risk. But you do need to also have that stable source of return as well over time. And so then this can provide you with a bit of security and a bit of diversification over the course of time. They can be a bit boring because they're much more multiple layered in how they work. I actually find them a little bit more interesting. And that's probably why I've stayed in bond markets for 20 years.
Wonderful. I have a few follow-ups. Okay, so there's different types of bonds, as you said, corporate, government, and there's like high yield corporate bonds from companies that are less creditworthy that could give a higher return. So not every bond is super low risk and boring. And how do most of the individual investors access them? They cannot buy individual bonds as easily as they would do individual stocks. They would have to go through bond funds, correct?
Actually, yes. I think there are platforms that allow you to buy sort of single bonds, but it does become much more complex. And even with equities, I'm not sure it makes too much sense buying single line equities. I think it is better to use a diversified type of fund. What you can do is you can pick something depending on kind of what you want as your risk level. If you want that investment to be pretty safe and secure, deliver you, say, I don't know, 4-ish% return every year with the level of your, let's pretend cash rates are kind of 4%, and then after 5 years give you your return back, then that's something lower risk. If you want a yield or a interest rate that's closer to 7 or 8, then you would want to pick like a high yield bond fund that would maybe give you that additional return over the course of time, and then might have also the ability for growth. And then there are bond funds that will do a bit of everything, and they've become quite popular. The reason why they've become popular is because, for exactly that reason, like most investors don't always know how much government bonds they want, or how much corporate bonds they want, or how much high yield bonds they want. They like the idea of something that's much more multi-sector in nature, that plays across different markets. So that can be a kind of neat and packaged solution that a lot of investors would use. But again, what you want to do is look at over time, how much return is this likely to give me, and how much risk does this have, and then compare that and decide what you should own.
Wonderful. And you touched on the year-to-date period already. I do want to mention again that back in 2022, when interest rates spiked, we saw both stocks and bonds fall, at least in the US at the same time. And you mentioned year to date, they have been less correlated. Bonds have been positive despite stock markets going down, which is good. That's what they're supposed to do. What's your outlook moving forward? Because for me, and I don't want to be too complicated here, but I do worry about inflation and interest rates staying high. I would love to hear your kind of market outlook for the bond market and interest rates.
I think that your 2022 example is an interesting example. Why did we see stocks and bonds sell off? What we saw, of course, in that environment was a inflation spike, and then there was some concerns around growth and things like that. And so you're absolutely right. What happened was central banks had to increase rates very rapidly, which led to bonds going down. That's the quickest they've ever had to do that, actually, to be very clear. So it was a very unique situation. And remember, we were coming off zero for most yield markets, right? So central banks were going from 0 to say 2 or 3%. And so that adjustment, because we were living through obviously the post-pandemic period, did make it quite a unique period. When we look going forward, I think you're right to think about the outlook, and particularly the inflation. If we think about initial conditions and where we are today and where we've come from, where we were was an environment where there was this probably assumption that the US was going to keep growing in terms of US exceptionalism, which would cause continued positive growth. Inflation was starting to come down because most of that inflation was due to those energy shocks. The central bank was able to start reducing rates back towards what people would describe as more normal levels. What has happened is that there's been two things that I think have been quite interesting. On one side, there's been a lot of noise around the tariff, and the tariff noise has spooked stock markets and worried to some degree investors. And what you're starting to see is some of the consumer sentiment indicators and some of the business sentiment indicators starting to trend downwards. Growth actually from the fundamental side actually still looks okay, to be fair. So growth looks okay, but it's been interesting to see that. On the other hand, your point on inflation, because of the tariff, there is some element of, is this going to cause price increases globally? When you look at what the US central bank, so the Fed, had said is that they view that as a little bit transitory inflation because it's a one-off adjustment in prices. When you see inflation going up, it needs to go up month after month. What will happen is you might see a price increase, but it's probably not going to be like once you've seen that increase, unless you see that pull through into wages, where there is some risk that could happen. But I think right now, the view is that, yes, there could be some upside risks to inflation, but you are not going to see inflation in those double-digit levels. And so that gives you a little bit of comfort that probably inflation is going to remain within high 2 handles or maybe low 3 handles. Then when you look at bonds and you go back to your question around what's going to happen to the bond equity correlation, there are going to be short periods where things might not move in the way that you'd want them to. But I think what's different now about 2000 versus 2022 is bond yields are higher. So even if yields go up a little bit from here, you've already got the additional interest rate or return from your coupon coming through. And that means that's going to cushion you much more so than the equity market is going to cushion you. So we think that over time, that correlation is going to be the way it would be historically. So either negative or very low. If you do get periods where that's not the case because of this inflation outcome, why is that inflation going to happen? It's probably more likely going to happen because of a growth. So might happen because what you're going to see in addition to inflation is probably a growth shock down. If you see that, then probably the Fed will have to then cut rates anyway. So I think it just depends on the type of inflation you get. I don't think you're going to get the pro-growth inflation, which is what we saw after the COVID pandemic. That's how we view it. So right now, when you look on a risk-adjusted basis, bonds actually look quite attractive relative to fixed income. The yield is higher versus the S&P overall, and it gives you a bit more protection on the downside. So right now, if you look at them from a valuation perspective on a yield basis, bonds are looking a little bit more attractive than equities.
Great. And the yield is the interest rate that you expect to get.
That's
from
right,
the
yes.
Great. There's so much good information there. So we don't expect a major shock like 2022, even if rates go up a little bit from here, because rates have adjusted from the zero that we had for more than a decade. Great. So let's talk about trends. What's the most exciting trend right now in the fixed income market?
Yeah, it's a good question. I think there's lots of different and interesting kind of things going on. And one of the areas I think that kind of continues to be, so fixed income has always been a sort of innovation, I would say, things that have happened in the fixed income market. So if you think about the first bond was this UK gilt issued bond, I believe, like many years ago. And then since then, you've just had a lot of financial innovation, whether it's corporates, the type of bonds they issued. You then had a thing called securitized assets. So securitized assets where you have homeowners that have mortgages and then they were packaged up, sent out to investors. That led to the financial crisis in 2008. When I think about innovation going forward, I see two things I think that are quite interesting. One is that sustainable bond transition. So the fact that you can now buy bonds that have targeted use of proceeds for companies that are looking to, for example, decarbonize, and they might want to have less in coal and more in renewable energy. So you can finance very specific projects. So that would be one.
So it's not that the company itself is like doing something overall, their whole product line is sustainable related. It's more that they're trying to introduce more sustainability into their business, and you are financing exactly that.
That's exactly right. Yeah. So over time, that should lead to the company then becoming more sustainable. They have to start with various parts. And in fact, one of the things that was quite interesting is these sort of sustainability linked bonds. And those bonds were quite interesting because they put within their contract, in their covenants, that this company needs to move this much towards renewables versus non-renewables. If it does not do that, then the interest rate that the company would pay would increase. So that, I think, was an interesting innovation. So that happened a few years ago. And I think those are sorts of things that are continuing to happen where you can finance particular parts. Emerging markets, as I mentioned, is one area where you've seen that come to the fore. The other area is actually ETF, and particularly active ETFs. So in the past, if you think about an ETF, of course, they were mainly equity focused, and then you went to fixed income, but it's been mainly passive because managers have been a bit more worried about showing their holdings on a daily basis and all sorts of things like that. But now actually you're starting to see asset managers embrace that And it means that you get not just the sort of return of the bond market, but you can get additional return on top of that by picking those companies that you think are going to outperform over time. And that's now going to be available for lots of investors in an ETF format as well. So that is quite an interesting area. And then linked to that, there are some asset classes within fixed income, which as we've moved to this from passive to also wanting to offer active strategies as an industry, some asset classes you can't really do passively within fixed income, some sectors. So securitized is one of those that's quite hard to do passively. There's no real market that you can benchmark yourself to. So those asset classes and sectors now are going to become much more available to investors going forward. So those are the kind of two areas that I think are interesting right now and are keeping us quite busy.
Sounds lots of exciting new things. And on the active ETFs, it's interesting to see that there's a lot more on the fixed income side, a lot of more product coming out. And that, as you said, because they trade daily, the underlying manager has to disclose their holdings. You touched on that, but it seems like asset managers are overcoming that and they're just introducing more product because it is really a better wrapper, so to speak. It's a better basket to own the traditional mutual funds. It seems like investors are really embracing it too.
Yeah, I think about it as being vehicle agnostic, to be fair. I'm not sure if it's a better wrapper for everyone. I think it's a different wrapper. And I think for sure for people like me and you, it's a much easier wrapper to get your heads around for sure. I use ETFs myself. So I like the fact that there's more available. The other thing I think that's interesting is if you think about what passive is, if you've got a passive ETF, and sorry if this kind of gets a little bit technical, but you've got the sort of market return, but actually you don't get the market return when you buy a passive ETF, right? Because you have to pay the fee and you have this sort of bid-ask transaction cost. So you're always going to get less than the market return in a passive product. Okay. If you buy an active product, yes, you're going to take a little bit additional risk and maybe the fee is a little bit higher. But if you are doing this right, and you find a manager that you think can do this over time, you overcome that. And so you will get the market return at least, and plus some more. Whereas I think lots of people think that the passive is going to give them the market return, but it actually doesn't. It actually gives you a little bit less just because of the fee and the transaction cost. So even the fact that the active is going to overcome that and give you an additional return over the top is quite interesting. And actually, if you look in the market, a lot of the active strategies are not priced that differently from the passive strategies, because what's happened is the passive ones came out early. So a lot of them had quite high fees. But now as the active things are coming out, they're having to price very similar, but then provide, which over time should be a sort of more interesting product.
These thoughts, I think, are more on the fixed income side, because equity looks a little bit different from my experience, on the sense that...
Yeah, you're absolutely right. It is a fixed income thing. Yeah,
exactly. So this was more on the fixed income side, because on the active equity, the fees are just sky high and completely unreasonable in many cases. And it's been so many, depends on the sub-asset class within equity, of course, like US large equity, like so few managers have managed to outperform the S&P. So there have been some solid criticisms on that side, but we're talking about a completely different asset class here.
I think you hit on something that I think is quite interesting, which is that bond markets, and it comes back to one of your first questions, which was, you said bonds are boring, and then I said they're quite complicated. And the point is they're just more complicated. And because they're more complicated, what ends up happening is it's partly because the people that usually buy bonds, not everybody that buy bonds buys them for maximizing return. A lot of bond investors buy them to match, to pay for something later on. So they're not thinking about how much this bond is going to perform over time. The bond market is a 140 trillion bond market. If you look at the actual issuance of the bond market every year, it's multiple, like more than 10 times what the equity market issuance is, just because companies have to keep refinancing debt over time. And on top of that, what you find is there are just structural inefficiencies in the bond market because bonds tend to trade OTC. So because you've got buyers that aren't always economic buyers, because you've got the complexity of the bond market and the size of the bond market, there are just more opportunities that, without taking very much risk, actually have what we would describe as quite kind of structural alpha in bond markets, just because of the way the kind of bond markets are constructed and the complexity of those bond markets.
Yes, so I completely agree with you. Maybe boring is not the right word, but complex and full of opportunities. Let's call it that. So I do want to ask you about the European bond market. Can you tell us a little bit what that looks like? Are we talking about, is it mostly bank issuers? Who is issuing those bonds? And how does it look at it from a geographical standpoint?
Yeah, if you divide the European bond market in sort of two simple parts, you've got the governments, the sovereigns, and then you've got the corporate side of the balance sheet. And sovereigns is probably more than 60% in terms of issuance of the bond market. Within the sovereign space, the largest issuer is Italy, and then France. I think Germany obviously is one of the top ones. So it will be Italy, France, Spain are the kind of largest European bond markets. If we take out the UK obviously is a large issuer, but within Europe itself or within the EU, Italy is one of the largest issuers, as is France and Germany. They tend to obviously be priced off where the short-term interest rates are for the ECB. Right now, anywhere between 2 to 3.5%, depending on where you look on the curve. When you go out from there, you talked about the corporate market. Within the corporate space, financials as a sector continues to be the largest globally anyway of all issuers. And then obviously industrials and then utilities in terms of kind of the issuers. And within that, it will be based around, as you would imagine, where the largest European corporates are. You get a lot of, for example, French banks issuing. You will get a lot of, like on the German side, obviously more on the industrials, some French utility companies as well. And then media, comms can tend to be across the board. So within the European bond market, I suppose what you want to think about is sovereign versus corporate. And then within corporates, I would not be thinking about, there might be an element of thinking about a geographic presence, but I think more so than that, you should be looking at the company's balance sheet, what you think of that particular sector, and being a little bit agnostic about geographically where it is, because the reality is obviously they're all benched off the European Central Bank's rate. And when there are like issues in that market, the end regulator and the end is always the ECB, of course. So when we're thinking about them, we think about them a little bit agnostically between them.
Wonderful. So I have a question on AI. How is AI disrupting the asset management industry? And is the investor's job really changing drastically at this point?
It's a really great question. And to just answer it from the investor's standpoint first, I think the way AI, I wouldn't actually call it a disruptor, but much more an enabler, at least for now. It's making things a little bit easier in terms of analyzing companies' reports and things like that. So you have that. It doesn't substitute for fundamental underwriting, but you do get much more information just by using those AI tools. You can also use the AI tools for kind of patterns and understanding patterns, particularly at certain times of the year to understand seasonality. You can use it also when you look at Fed statements. It helps you compare very quickly side by side what's changed between the Fed statements. So I actually still, like for asset management right now, I think it's more of an actually quite a useful tool for sure. So I don't see it as a disruptor. I actually see it as something that will make the data sources quite richer. But obviously, it's a kind of developing area, and it's one where, of course, you just have to be very careful. We've had lots of training on it. You still need to have human interface and human intervention.
There's no ETF run by AI exclusively yet.
No, not yet. No, not at least in my organization, in Goldman Sachs, no.
Okay, that's good. And then, obviously, you've been in the business for quite some time. I want to ask you, what is the telltale sign that says this is a great investor?
It's a really difficult question, actually. I think it's somebody that has an appreciation for things outside of their purview, first of all, to help them spot whether you call them black swans or tail risks or whatever, and question that. Somebody that's willing to use the sort of tools available, risk tools and things like that, I think is clear. Every investor needs to have high conviction in kind of what they do, but I think be willing to learn from your mistakes and where necessary kind of close things down. So I have seen the opposite, where kind of people have held on to things for quite a long time because they believe that to be the case, and fundamentals maybe are right, but the point is like value trap can be like catch a falling knife kind of thing. It can go on for quite some time. And so I think you have to recognize that. In the bond market, a good example of that is if you look at the shape of yield curves, so how interest rates are versus maturity. And what you find is that the yield curve is supposed to be positively sloped. So you're supposed to get more compensation for lending money to someone for a longer period of time. But actually what tends to happen is you get it move in the other direction. It can go inverted. And you will see investors coming up with lots of reasons for that. But the reality is there is both the fundamental picture, the economic picture, and the technical picture. And unless you have an appreciation for all that information and the fact that not all that information is going to be relevant at the same time, then sometimes I think you can get very caught in kind of your own kind of trap. So I think being able to question your decision making, calling in others is probably important, but obviously having confidence in your decision to not also flip flop. So having a much more disciplined view of things and not necessarily being drawn by day-to-day news flow. So in the bond markets, if the payrolls data comes out or GDP, bond markets can start moving around. If you have a view on something, as long as you have done the analysis, then you should probably hold on to that view. You should have probably scaled that view in a way that doesn't make you too uncomfortable. But the point is you don't want to be so reactive to things over time.
It's a delicate balance. Exactly.
And that's right. Exactly.
Yeah. So one of our other final questions, there's still a lot of room in the asset management industry to include more women decision makers. I've seen so much push to get women in investment banking, but less so on the so-called buy side, right? The asset management side. How do we get more women in asset management?
That is, I think, an interesting kind of question. And I think first and foremost, at an analyst level, so at very junior levels, you just have to be willing to have that diverse balance sheet and recruit and have slates that are diverse. Okay. And there are ways to do that. There are lots of programs that have been put in place at universities, whether it's Girls Who Invest or these particular programs that are put in place, etc. So I think at a very junior level, you have to make the investment, which is a little bit frustrating because you don't see results as quickly as you'd want to on the senior leadership side. But I do think that if you don't do it at the junior level, you're never going to get there. And then I think once people are in, I do not believe in just putting someone where they are because they're a woman or because of their diversity or whatever. I actually think that's never worked, and I think it doesn't do any of us any favors. But I think that ensuring that women have the support that they need and can, whether it's from an employer perspective or just having a bit more of an open place where they can talk and have those discussions, I think that will keep women in the industry and women's sponsorship. So as people become more senior, I think it's up to them to help others. I think it is going to be a little bit of women, a little bit of men, where we do have to help those that are rising for sure. One of my very good advocates was a woman, and she was a fantastic boss. Still I'm in touch with her. In fact, I have two bosses now. One's a woman, one's a man, and I don't really see them very differently, and they don't treat me differently. But it's nice to be able to, there are some things that are much easier to discuss with a woman than they are to discuss with a man. And also a lot of my friends that I've made, I've gravitated a lot towards other women. So you have to find a little bit your tribe. So I think it's junior level recruitment. And then once people are in, we as individuals need to do more ourselves. Once you're in the industry, you probably have to seek out people that inspire you and so on. They don't have to always be women. But then I think also as you become more senior, I think you just have to take that time out to be willing to coach others and help others. And then for sure, companies can put programs together and things like that. I think the jury's still out on what works and what doesn't work, and it's different for different people, to be fair.
Wonderful. And if we can squeeze one last question in.
Sure.
Do you have a personal motto or guiding principle that you live by?
Take your time and don't rush, actually. All my life, I sort of was in a race for things. And then I've realized over time that I just need to sometimes take a step back, and it's not a race at all. The reality is I think that there's no point comparing yourself to other people. It's much better to be on your own journey and enjoy what you're doing and be happy with what you're doing, because actually a lot of the things that you're doing on the way you miss if you don't slow down and just look around and take a pause.
Wonderful. I love it. I was not expecting it, but it's such a great insight. That's a wrap. Tina, thank you so much for joining us on the podcast and for the wonderful insights into bonds that you shared with us.
Thank you so much. It's been a real pleasure.
And thank you all for listening to the Investing in Other Stories podcast. If you enjoyed this content, please take a moment to subscribe to and rate the podcast on Apple, Spotify, or wherever you get your podcasts. You can follow me, Margarita Triantafilido, at Finance Latte on Instagram or on LinkedIn, and Tina Adatia on LinkedIn. Cheers and see you next time. The information provided on this podcast is for informational purposes only and should not be considered investment advice. The opinions expressed on this podcast are as of the day of the recording and are subject to change without notice. The views and opinions of guests on this podcast are not necessarily those of Finance Latte AB or its host Margarita Triantafilido, collectively referred to as Finance Latte. Finance Latte is not affiliated with its guests or their affiliates unless otherwise stated. Finance Latte does not guarantee the accuracy or the completeness of the data presented herein. The information on this podcast is for informational purposes only, and the information, data, analysis, and opinions it includes should not be considered investment advice or tax advice, and is therefore not an offer to buy or sell a security. Finance Latte AB is not responsible for damages or other losses resulting from or related to the information, data, analysis, or opinions in the recording. Past performance does not guarantee future results. All investments are subject to investment risk, including loss of principal. Individuals should consider their own unique needs and circumstances and objectives before making investment decisions. Please consult with a tax or financial advisor for advice specific to your individual circumstances.